The debate in the US is growing about whether we would be seeing an interest rate hike this year or next year, and it seems that it is looming at this stage. We know that investors are after yield. We are seeing bond yields rising in the US. South Africa does offer that yield. We know a lot of European countries and other emerging market countries as well are offering great yield as well. Do you think investors are going to become far more picky in terms of which emerging markets they'll be looking at?
Yeah, absolutely, because emerging markets have run the hardest and has run first. G7, and I'm excluding China now, so big Western economies, they've appreciated in value, but they've still got a lot more room to run than, say, for instance, emerging markets such as South Africa. And you shouldn't just base that on price to earnings ratios and current price to earnings ratios, because those are so distorted at this stage in any case. The point, though, is that for emerging markets to continue running the way they do, they have to start showing the growth. The companies have to start showing the earnings numbers and so on, and then drive the overall price-to-earnings ratios and overall valuations for those markets down. So you've got this big group internationally where the earnings are going to start flowering and start coming to the foreground. That should drive markets higher. You've got it happening in emerging markets. Has to happen quick in emerging markets, and therefore, you know, your downside protection needs to be in place, predominantly because your markets could cool down from these levels by a bit. Obviously not 40%. It's not it's not kind of in crash territory. Just by the side, I mean, the Federal Reserve, their biggest issue is inflation. You know, they want to, when they see inflation, they want to try and cool it. And at the when they start seeing inflation start building in that economy, there's a certain level that's pretty healthy, and then beyond that, when it starts getting into those territories, they'll start hiking rates. And not until that happens, you know, the Fed are inflation watchers. And at this stage, they're trying to look at inflation, but they're trying to get an economy going as well at the same time. And the American economy, you know, don't underestimate it. It's still a $14 trillion economy in the world. And Americans can change what they do and how that economy works very, very quickly, and find a new reason why people should invest in America.
Of course, and when you ask that question, I mean, the World Bank, as I said earlier, is expecting GDP growth in East Asia to come in at 8.7% for this year. For China, they're expecting 9.7% in 2010 and 8.7% in 2011. So when you look at those numbers, I mean, who's offering growth and growth at these levels? It's obviously East Asia.
And those numbers are getting revised all the time. So every time we look at those numbers are being revised up. And that is predominantly because we had such a pessimistic world 12 months ago that if you said to somebody, look, do you think Asia can grow, or Southeast Asia can grow by 8.5%? 12 months ago, most people would have said to you, absolutely not. You know, that's ridiculous. You know, why do you even think like that? You know, whereas 12 months later, it shows you how quickly this recovery has actually happened, which is good and favourable for the world, I think.
I think also the Geithner report at this stage is under the spotlight, and we know that there's a lot of concern and growing debate about the Chinese renminbi and whether it will be allowed to be free floated. And it seems that China is making some kind of move towards that. But the question is, how much of a move are we going to be seeing going forward? And do you think it's going to change the way that we'll be viewing currencies as well? I mean, do you think we'll be seeing even more buying into China because the yields there are amazing, and we know that growth there is going to be quite robust?
Look, firstly, I mean, there's a difference between free float currency and we're going to look at the currency. You know, I think the Chinese have said, look, we'll look at the currency, and they've given 3 caveats to them looking at the currency, and then one of the caveats is that it's still controlled, which kind of flies in the face of free float currency. You know, whereas you look at the South African rand, it's a free float currency. It floats with the rest of the world currencies, and depending on mood, it shifts relative to other currencies. That's not necessarily what they're trying to achieve over the short term. Maybe over the long term, maybe that becomes becomes evident in that economy, but certainly at this stage. I think you have to separate what happens in company space in China than what happens with a currency. If you find a company, you like the company, you think it's worthwhile being in the business, the yields look right, it's the type of business you should be looking at. And if you can't get into it in the Chinese market, there's certainly the Hang Seng, which has got a far larger history attached to it.